So I think the old guard to new guard kind of shift is really occurring right now. We always talked about it. We always thought it was coming. I think we're here. And the business, to be honest, it's like fun again.
Rob, Adam, thank you so much for joining me today. Let's kick off this conversation talking about the current state of the mortgage industry. What market dynamics and trends do you see really defining mortgage over the next 12 months? Adam?
Yeah. Hey, Rob. Nice to see you. Clayton, great to be with you again. As we continue to talk to our partners throughout the industry, top of mind for everyone continues to be recently on rates coming down and the impact that will have on the mortgage industry. Obviously, it's been a tough couple of years for folks. There's been consolidation and so forth. And now there seems to be a lot of positivity and some momentum going into the back half of the year and certainly into 2025, where there could be, a market that goes from 1.6, 1.7, 1.8 trillion to, 2.2, 2.3, 2.4, whatever it will be. And so we've been really having a lot of discussions internally and, of course, externally on how to support that, whether it's thinking about refi or other product offerings, and then, trying to incorporate technology and try to and to think through how to scale this thing out internally for each of these partners of ours more effectively.
Yeah, it's about this market condition right now. We're seeing, obviously, everyone's kind of focused in on interest rates, and with the Fed's move recently, people were anticipating a much quicker drop in rates, and we're not seeing that maybe right now, but everyone's kind of on this along the same lines that over the next year we're going to see rates to trend down. So refi is now back in the picture, and something a discussion point for all lenders. The cost to complete is a metric that everybody's going to be really focused in on, and making sure that they're able to scale at a level that makes sense for the business. Because this time around, you can't just throw human capital at it like we did in 2020 and 2021 when rates dropped significantly. Because in the markets today, you're just not seeing the premiums and the security going forward. So I know we want to throw in, taglines like AI and what we're going to be implementing. And I think a lot of lenders are going to be doing that. But really, how do you find a way to scale your business at a cost level that makes sense just because of the way the market is and the way loans are pricing today?
Okay, so two big themes there. Rates and costs are clearly driven by technology. So let's talk a little more about rates, and then we'll dive into technology, specifically with you, Rob. So rate sensitivity has been a big topic amongst lenders and borrowers. So Adam, what practices are you seeing in the market for adapting to different interest rate environments?
Yeah. Similar to what Rob said, a lot of our partners are talking to us about how to optimize recapturing their existing servicing asset, how to look at their existing their pipeline on an ongoing basis, and or monitoring their locked pipeline for reduction in rate and so forth. So we've been talking with them about that, and as well. As Rob hit on, everyone wants to be able to do every incremental loan on a more cost-effective basis and drive down the cost of origination, which actually is at an all-time high, funny enough. So, we've been able to install things like our AI platform, particularly for loan officers and other, just our core pricing engine, and been able to demonstrate driving down that cost of origination for them, not only in this market, but it also allows for them to scale up, say 20, 30, 50, whatever percent, while keeping their cost flat. And to Rob's point, I think what everyone is looking to do is avoid having to staff up in a major way like we've had to do in previous positive cycle environments, and instead keep the team size static, but leverage the latest and greatest technology in order to scale their business up.
Rob, can you tackle that question as well and take it through the lens of preparing for an interest rate environment that's great for purchase and an environment that's great for refi?
Yeah, a purchase is always going to be the core business. You have to focus in on that because it's going to get lost if rates don't come down, right? Everybody's kind of we know the markets love to play a little bit of the Kansas City shuffle where everybody's going one direction and it goes the other. So we have to be careful for that and make sure we're preparing and scaling in a fashion that can sustain, if rates stay at this level for a little bit of time. Maybe it's a 6-month delay before things start to come down. But I think one thing that gets lost in this, and people always talk about rates and rates coming down, what we've seen over the last few years is this premium is disappearing, right, on loans. And you're seeing this. I think in 2020, 2021, like the lowest paying Ginnie coupon was paying 103.5. And today, the highest paying Ginnie coupon is paying 102. So it's a big difference in where we were in premiums and how we can build our business. It was easy to do things with human capital and with the rate move that was happening, and loans were paying 106. And you can hide a lot of mistakes in 300 and 400 basis points of margin. There isn't 300 or 400 basis points of premium to be had on a loan. So you can't hide. So you have to scale properly. You have to do, like I said, all the things in terms of technology and being really efficient in your kind of loan manufacturing process. And separately, the capital markets world is more complex than it's ever been. It used to be that there was a TBA security was your price, and that's how it started, and everything was based off of that. And that is true, but a lot more of the volume was just going to that price. Today, there's stories, there's things that are happening in the capital markets world that we need to partner with companies like Poly to be able to get those specified pools and the specialty pricing and pay-ups for these stories through to the originators that are on the other side selling these loans to consumers. So it's really important that you get the right technology partner and really try and figure out how do you get that back end piece, which is always kept for lenders to make a little bit more margin. It's so competitive now. You need to put that in the forefront in your pricing engines. And that's why we're working with a company like Poly.
Yeah, that's phenomenal, Rob. And you're dealing with a lot of change right now in the market, market-driven and technology-driven. You're also in a new executive seat. So earlier this year, in February of 2024, Proprietary Capital announced the acquisition of American Financial Resources, AFR, and you joined the organization as Chief Operating Officer. So a lot of change for you. As you come into this new role as COO, what are your top priorities for AFR?
Yeah, everything.
Everything.
We have to do everything. No, it's amazing. So, a full circle moment. I was at AFR before, and I won't get to the long story. Left in 2017, 18-ish, and then came back. But I did a stint in the broker world as well. I opened my own broker shop. Kind of got back to the roots of origination. I had been in an executive seat and capital markets seat for many years at both AFR and then also Ditech when we sold to NewRez. So sitting in those seats, going back down to the ground level and really focusing in on originations and finding that holy cow, there's this incredible opportunity in the channel, in the wholesale and kind of non-delegated correspondent channel. So having the opportunity to come back to AFR, I did some consulting for Proprietary Capital and found the target and kind of talked through it with them. I was very familiar with AFR. So when I got a chance, when they offered the opportunity to come and lead the organization from Proprietary Capital side, I jumped at it. It was something that, was an amazing opportunity. It's coming home. For me, there's, I think 85% of the team members were here when I left. So it's very rare in the mortgage business. So we saw that and got to come back and bring in a kind of a different view. And for us, the main priority really was around experience. And we talk about tech, ops, and rates and pricing and stuff. But for me, it was all about the experience. We had lost a little bit over those years of what the customer experience was like, what our own team members' experience was like. So we really had to kind of reshape and we created a whole new core value system with the company and really focus in on elevating the experience for our customers, for our team members. And that's been our main focus. And with that comes our technology upgrades we've been doing in our portal, dealing with and kind of dealing with what the legacy technology was, rebuilding on really good architecture that we had, and then bringing in companies like Poly that can really help shape us to what we want to build, not what we have and what's kind of in the past, but really shape where we're going. And that's why we want to partner with people that kind of have that same vision and insight in what we're doing, because we're building something pretty cool here at AFR and eLend, and we want to bring in partners that want to help build something cool.
It's not easy to align culture, employee experience, customer experience, and technology into at the same time to form a more efficient, better company that provides a better experience to consumers. How are you handling that alignment between all the other operational factors and new technology?
Yeah, it's a slow and steady implementation. I mean, you jump in and you want to make like 7,000 changes, right? So we put them on the board. We know what we need to do. We know where the most impact is going to be is when the customer is in contact with AFR. So we're focusing in on our portals, the communications to whether it's our customer's customer, our broker's borrower, our own borrowers, focusing in on that experience and bringing in technology there. And obviously a pricing piece to that is a big deal. The manufacturing process is the big deal. And then at the end, how we securitize and pool the loans and how they end up in our subservicer, and how that whole transition goes is a big deal. So that experience and those touch points is the first impact. If I have to immediately make some changes or make some process changes internally to make sure that the experience is better or put more resources into that, that's something that we'll do. And then we'll build the technology around those processes that we see there's gaps. But there's no, it's non-negotiable when it comes to the experience. And that's where all of our dollars are being focused in on right now.
As proprietary capital came into AFR, I'm sure there was a business case created and presented on how the company would grow. What tactics are you deploying right now to grow market share for AFR in this, first year and first few years of leading the organization?
Yeah, it's really nice to have investors that are aligned in your vision and are patient, right? You always see that it's not a flip model. They're not looking to invest and get out in a few years. They love the business. They saw the opportunity in the business and deploying capital into the business. And that's really important for us. But really, it's really easy on a spreadsheet. I'll say that when you're modeling stuff, you're like, oh, just grow by this percentage and you flow through. That's simple. In reality, it's winning over one broker, one manufacturer, home dealer, one realtor at a time, and one correspondent seller at a time. We are literally going one customer at a time in our approach here. It's been working, and we've been growing, especially in the wholesale and non-delegated channel. I think we've grown over 500% since February in our production there. So, but that's our tactic right now. It's really getting out a lot of face-to-face and a lot of kind of trying to change the perception of what AFR was, which is a niche kind of construction lender, renovation lender, to being mainstream, because some of our pricing is the best out there, the best right now in the industry in certain segments of loans. So we want to get our word out that it's a little bit of a different company. And we have a little bit of a different process, and really investing in again, those touch points of the customer and creating a really good experience for them. So that so far has worked. And like I said, for us growing, we have 3,000 approved customers or so in that range, but not a lot are sending us business. So just with our own customers, winning them back one customer at a time.
Adam, Rob mentioned that it's really easy to model these things out in a spreadsheet. You have the benefit of working with a lot of lenders and seeing customer acquisition strategy and pricing strategy in action. What trends are you seeing right now in pricing strategy, and what are lenders doing to separate themselves from the competition?
It's similar to what Rob has discussed here a little bit here, where everyone's really, really focused in on how can they get far more granular, far more dynamic, far more flexible in their pricing approach, and as well even how they're configuring back-end work streams to automate the interaction between, say, the mortgage broker and and their team internally. And so, take a company like AFR, who's like on the forefront of this stuff with us, and it's been phenomenal, right? Like they're pushing, they're challenging, they want us to build new things, and it's been great. And our job is just to listen and learn, and what can we do different? What can we build? And it's been phenomenal for I hope, for both companies in that regard, because as I've said in the past, the industry has been conditioned to operate, in a certain way for 20, 30 years, and they've never known anything differently. And so all of these workflows and the amount of people and process and policy have been wired up based on all this legacy software. And so now, when you can partner with Rob and his team on building, getting hyper granular, whether it's spec or looking at HFAs or looking at, manufactured housing, whatever it is, and getting super granular using however many parameters are required to be able to price that loan and optimize the margin per loan, and then automate all the back-end workflows. It's really creating strong ROI for companies like AFR and others.
Yeah, it seems like there's a kind of a tale of the haves and have-nots in mortgage right now. Those that have been able to leverage strategy and technology to be profitable, and those who are still operating antiquated cost structures that's kind of lagging, pulling them back. underwater, not profitable. Adam, like, what is the difference between like those haves and have-nots? What are the haves doing that the have-nots have just not done?
Well, I think if we just listen to what Rob has said, I think it's like that's like the bar, right? Like having a long-term vision, ensuring that the values, the culture, the team, et cetera, is all totally aligned. And then where can technology and other parts of, whether it's internally or externally, help that strategy and that vision? That's like number one. And so as soon as that occurs and a lender brings forward a long-term plan that's more than 6 months or 12 months, that's step number one. And then, like what Rob said, once they commit to a long-term plan, then you've got to go execute on that plan. And it's like what Rob said, it becomes non-negotiable. You know, if you're going to say, hey, I'm going to drive my cost of origination down through the most cutting edge technology or certain types of, whatever culture, values, whatever, then those things just have to happen. And you can't deviate from those things. Otherwise, there's misalignment. And so what we see is exactly that. And so, there's a growing list of lenders and banks and credit unions that are taking that approach. And then there are some that are not. And what's happening is the rising tide is lifting all boats for those that are, and then those that aren't, if they're not originating loans as profitably, or they might be negative. And eventually the rubber will meet the road. And, maybe in a good market, maybe that masks it a little, but maybe not, because then Rob's, an AFR will be able to do a lot more volume, far more profitably, probably as a result, retain more servicing. So, in the next down cycle, they've got a bigger servicing asset generating more cash, or just have a bigger balance sheet. And they're in a position to then reinvest again and prepare for the next cycle. And so you see this kind of halo effect for companies like AFR under Rob's leadership.
Rob gave us a quick glimpse into his changing and evolving product mix as they take control and put in place this new strategy for AFR. Adam, do you see any other product mix changes that lenders are focused on as they seek to meet the changing demands of borrowers as we look into 2025?
It's funny, if you would have asked me this question 6-9 months ago, it'd have been very different than it is today. 6-9 months ago, people were talking a lot about seconds or maybe more non-QM. And now with lower rates, I think people are saying, okay, how do I just go do a bunch of agency and FHA and streamlines and VA and enrolls and so forth? Maybe we're going to be a little less focused in on seconds or non-QM or other products that might be a bit harder to manufacture or slower to manufacture and so forth. And so we're starting to see a bit of a mean reversion, I would say, in that regard. People are still interested in seconds and non-QM and so forth. But as lenders think through what next year and the year after looks like, it seems that there's a greater emphasis on agency and govy, jumbo, and how to drive profitability on those particular products. Still, there's a lot of non-QM that are getting done, but I would say that the inbound inquiry related to those, maybe seconds, for example, we see less of that.
Okay, guys, let's close out with a speed round question. What are you most excited about in terms of opportunities in 2025? And the answer can't just be lower mortgage rates. Rob, you want to kick us off?
I think opportunity in certain channels. We think there's segments in the business out there right now, and really focusing in on the wholesale channel. AFR really loves that channel. We think there's great. The top two are really, really good, and then we think there's incredible opportunity to kind of leapfrog in that channel. We think there's a lot of people have migrated there. We think it's one of the best places to get a loan. And we know that from the origination side, it's the broker channel is solved for the last mile of origination for a lot of companies like ours. So we want to use those originators, boots on the ground versus having a larger distributed retail, a little higher cost structure, and really focus in on that channel. We think that's going to be a really good opportunity as rates do come down a little bit, inventory hopefully goes up, get more buyers in. And then the trick is going to be, the recapture of that, and that channel's always kind of lagged of what happens in terms of recapturing that MSR, and you're seeing it in pricing. So that's something we're going to focus in on for our broker partners, and trying to figure out the best pathway to give that original origination, and then obviously the opportunity for refinance down the road.
Yeah, for on my end, of course, I'm really, really excited about continued technology adoption. I mean, of course, I'm supposed to say that, but I actually do think it's had a material impact in generating really strong ROI. But what's most exciting to me is not just, oh, let's adopt new technology and see how it works. What's really, really exciting about this to me is we're starting to see all of this positive momentum going all the way almost to the consumer experience, but certainly to the broker and LO experience. And what tools like our AI Copilot or all of this other automation we've built on the back end, and how that enables success at the point of sale, so that lenders and banks are able to be not only far more efficient and more profitable, but have a far better user experience between their AE and their loan officer and the ultimate consumer. And the mortgage industry over the years has trailed other industries at the point of sale in terms of the experience. And I think it's really exciting that we could end up delivering a consumer experience that consumers are used to from other industries that they might not have had the access to in our industry. And I think that becomes really exciting and really compelling, and a real differentiator for lenders and banks.
So I think the old guard to new guard kind of shift is really occurring right now. We always talked about it. We always thought it was coming. I think we're here. And the business, to be honest, it's like fun again. It's fun to build and create and have the technology and be able to adopt technology. Before, it was always like that, return on investment. Is it better to outsource or build something with technology? It always made sense financially to just outsource it. We didn't really build anything cool. And now we're in this kind of stage of the game where building makes a lot of sense. Deploying technology has immediate impact on what the cost to complete is going to be across the organization. And it's just a lot of fun right now to be in the space.
Yeah, I second that.